Hello everyone, I hope you guys are doing well and studies going in full swing. So in today's video, we would be discussing the all important IND AS 16 from your CA final FR, that is on PP, along with the important questions for the same. Now this is one topic which you can easily rate close to the tier 1 category in terms of importance, because individually it is an important standard, but at the same time it kind of builds the framework on which IND AS 38 of intangibles as well as IND AS 40 on investment property kind of stands. So let us get started. So first is, what is a PP? Well, PP refers to items which are tangible, that is have physical form, held for use. Use can be any use, it can be administrative use, selling and distribution, production, or even general for employee personnel. It can be any use. And the life over here should be more than 12 months. So if all of these criteria are met, we can say that the item over here is PP. So if you are holding an item, let us say for sale in the ordinary course of business, that is inventory and it will not be covered under PP. But other than that, if we say use, which is a very generic term, it should go under PP. Now there would be certain scope exclusions of items which are not covered under, let us say, IND AS 16. First being non-current assets held for sale, because usually these non-current assets, like you might buy furniture, but sooner or later you might have to sell that furniture, and as a result this furniture, once it is decided to be sold, is no longer held for primarily for use, and hence it is classified under a separate accounting standard called as IND AS 105. Second is your exploratory and evaluatory assets. That is a very specific case pertaining to IND AS 106. Not very important from the exam perspective, because 106 itself is not there in your CA final. And lastly, biological assets. Now this is something which I would rate is slightly important. Biological assets are those assets which have life and are controlled by the entity. So first of all, if you say which biological assets have life, we say human resources. But remember, human resources in general cannot be controlled, and as a result human resources are not assets only, let alone PP or let alone any other asset in general. So other than human resources, you will have living plants and living animals. So living plants can be subdivided into two categories. There is bearer plants. These are plants which bear agricultural produce but are not produced themselves, like a coconut tree, mango tree, etc., which is covered under IND AS 16. So this is a biological asset covered under IND AS 16. So that is not a scope exclusion. But other than that, every other biological asset which is used for agricultural purpose, which can be other than a bearer plant, like for example an annual crop like a wheat grain plantation, or let us say something which is like a bamboo tree or a teak wood plantation, which is itself the produce, will be covered under IND AS 41. So when you look at other than bearer plants, IND AS 41 applies. And living animals which are used for agricultural purposes. What is exactly agriculture? You will study under IND AS 41. Predominantly agriculture covers, let us say, activities whereby you are selling biological assets or converting biological assets into agricultural produce, or uh, holding to generate more biological assets. So you will do that in IND AS 41, but nevertheless these would be agriculture. So if you have a living animal like a security dog, or you are holding animals in a zoo, you are not holding them for the agricultural purpose, and hence IND AS 41 will still not apply. IND AS 41 will apply for living animals which are used for agricultural purposes. All animals used for agricultural purposes, like cattle for example for Amul, will be covered under IND AS 41. So long story short, when you look at the scope exclusion, biological assets used for agricultural purposes will be covered under IND AS 41, except for bearer plants, which will be covered under IND AS 16. Okay, so this covers regarding your biological assets. You will do that at length when you do IND AS 41. Generally bearer plants are usually fruit plantations, or tea, coffee, rubber plantations are usually bearer plants. For other items, the institute should ideally give you guidance of the nature of the plant, and accordingly you can decide whether it is bearer or non-bearer. Now beyond this, the standard is subdivided into four main headings. First is initial cost, initial recognition, which happens at cost, then subsequent expenditure, subsequent valuation, and depreciation. We'll take up each of these items and then go to a couple of important questions which kind of cover most of these areas. So first is initial recognition of PP should happen at cost. Now how do you determine cost? Purchase price less trade discount. Remember, cash discount is defined as discount linked to early payment. Trade discount is a discount other than cash discount. So purchase price minus the trade discount plus you will have non-refundable, non-creditable taxes, plus directly attributable expenses which are necessary to get the asset in the location and condition as desired by the management, that is ready to use condition. All of these will be added into the cost for a purchased asset. Secondly, if this is a manufactured asset, then instead of the purchase price, you will have like your cost sheet, direct material, direct labor, direct expenses, plus overheads. Overheads can be factory overheads which are either fixed or variable, cash or non-cash, that does not really matter. All overheads which are directly attributable to getting the asset in the ready to use condition should be capitalized if they are factory overheads. Generally, selling and distribution overheads or administrative overheads are not considered to be directly attributable and hence will not form a part of the cost. Now, this is a general category of cost categorization. The standard gives you some guidance on what should not be treated as directly attributable and a few other special cases like borrowing costs, site restoration, etc. But first, what should not be treated as directly attributable? First, any inauguration expenses or losses or expenses after the asset is ready for use, or employee or staff training expenses or relocation expenses. So these are four categories of expenses which the standard itself says will not be treated as a directly attributable expense and hence should not be added along with the cost of the asset. What applies for directly attributable expenses should also be applicable for directly attributable incomes. Like for example, there may be a pre-production testing. Now pre-production testing is necessary to get the asset in the ready to use condition and as a result it will be capitalized. But on testing you might get certain output and you might sell that output. So the proceeds that you get on selling that output is directly attributable to one of the costs which is required for the purpose of recognizing the asset, and as a result pre-production testing minus any proceeds that you get from selling the products will be the net amount will be added to the cost. So long story short, if there is any income that you get on selling a particular product from pre-production testing, that is a directly attributable income and has to be reduced. In fact, the standard over here goes on to say that it is possible hypothetically that the testing cost is 100 whereas what you get on selling is 150, in which case your recognition would be done considering 100 minus, let us say, the entire 150. The additional amount can be taken, let us say, to the profit and loss account. So if it is a directly attributable income, then it is to be subtracted. But if it is, let us say, not directly attributable, like you are constructing a factory and you have to give some surplus land, etc. on rent, that is not directly linked to construction, in which case it will be going to the profit and loss. So this is the guidance regarding directly attributable expenses. Then you have situations like losses can be abnormal or normal. If you look at abnormal losses, they will be taken to the profit and loss, whereas normal losses are usually added into the overall cost. And lastly, you have the all-important provision for site restoration. Now, when we look at provision for site restoration, decommissioning and site restoration, this is the cost that will be incurred as a consequence of the obligation that you have to dismantle the asset. Now, the dismantling obligation may arise due to the fact that you are constructing the asset. In such a case, the obligation will be discharged. So let us say you have constructed an oil well on which you have an obligation to dismantle the oil well once you leave the place. Now the obligation gets created the moment you construct. You are under an unavoidable obligation to dismantle. You might dismantle it after 10 years. However, we are not following cash system of accounting, we are following mercantile system, and hence you recognize the provisions as and when the obligation gets created. The obligation to dismantle, the event that gives rise to the obligation to dismantle is actually construction of the asset, and hence the moment the construction is completed, you will create a provision for site restoration. Now this provision for site restoration is created if there is either a legal or a constructive obligation to dismantle. Even constructive obligations are included. And this is created at the present value of the estimated expenses that are likely to be incurred to kind of dismantle. So here what you will have to do is, let us say 90 rupees is the initial cost to construct the asset, plus after 10 years you are likely to dismantle and you are likely to incur, let us say, 40 rupees of cost. So you will try to find the present value of, let us say, 40 into the discounting factor at the rate of 10%, let us say hypothetically comes to 15 rupees, 15, in which case the PP will be recorded at 105, that is 90 rupees, which is a construction cost, plus another 15 rupees. That is a cost incurred to kind of dismantle. So your journal entry will be PP account debit 105 to bank, let us say 90, to let us say provision for site restoration at 15. Now this PP will be depreciated over the course of 10 years at, let's say, 10.5 each year to come down to a zero balance. But what happens with the provision? Does it continue to remain at 15 rupees? The answer is no. Why? Because this provision after 10 years is likely to move to 40 rupees, and you are expecting to pay 40 rupees assuming your estimates are correct, in which case you will slowly take the 15 rupees all the way up to 40. This process is called as unwinding of discount. So in the first year, 15 into, let us say, 10%, that comes to 1.5 loosely. Second year, that provision will become 16.5 into 10%, that is 1.65, and so on. So over here, you, as each year goes, time passes, your provision increases. So your provision has to be credited, but something has to be debited. So what will you debit? Will you debit the PP? Answer is no. Why? Because the additional amount beyond 15 rupees that you are paying is not because of the asset. It is because you are getting 10 years to pay it. If you had to theoretically pay the entire amount today, you would not have paid 40. Probably today you would have paid 15 rupees. But instead of paying today, you are paying after 10 years, and as a result, the additional amount is linked to passage of time, and hence unwinding cost is taken to the P&L under the larger heading of finance cost, in such a way that slowly this will reach all the way up to 40, and then once the dismantling actually happens, provision account debit to bank, and that will be, let us say, done at 40 rupees. But is it possible that there is a possibility that there is a change in the estimate during the life? Yes. Assuming you are following the cost model, after, let us say, 4 years, if there is a change in estimate, you believe that something which was worth 40 is now going to be, let us say, worth 50. So now how will you adjust for the additional 10? Remember, 4 years have gone by, 6 years are remaining. The change in estimate is happening after 4 years, and because it is a change in accounting estimate, the effect will be given to prospectively. So you will say that at the end of the 4th year, whatever is the balance in the site restoration is basically your estimate of 40 rupees, which are expected to incur after 6 years. However, the revised estimate is 50 to be incurred after 6 years, and hence the additional 10 discounted at the rate of, let us say, 10% for the remaining 6 years. For example, that comes to around 5.6. So you will create an additional provision, because now based on the latest estimates as per Ind AS 37, you'll have to create a provision based on the best estimate at the balance sheet date, which is 50 rupees into the present value factor for 6 years. And hence the provision will be increased approximately by 5.6. The second effect will go where? Well, this makes the PP costlier. Your initial recognition of the PP was based on an estimate that 40 will be incurred. Now, all else remaining constant, 50 is likely to be incurred, and hence the additional amount at present value terms will be adjusted against PP. If there's an increase in provision, PP will be debited. If there's a decrease in provision, PP will be credited by the present value. Now, this is the case if provision for site restoration is adjusted, let us say, at a later date, pertinently into the cost model. Also, if there is, let us say, borrowing cost, for that there's a separate accounting standard called as IND AS 23, which says that borrowing cost should be capitalized for a qualifying asset. That is, an asset which necessarily takes a substantial period of time to be ready for its intended use. Your borrowing cost will be capitalized from the commencement date, that is the letter of the date when loan is taken, activities commence, expenditure incurred, and the capitalization will continue till the time the asset is ready for use. The moment substantially all activities to get the asset in the ready to use condition is completed, capitalization will stop. Even if you are paying interest further, it will go to the profit and loss account because the asset is ready for use. How will you figure out in an exam whether an asset is qualifying asset or not? Typically the institute will tell you whether the asset is qualifying or not, but if it does not, then generally 12 months is taken as the accepted barrier. If the asset takes more than 12 months to be ready for its intended use, it is qualifying. If it takes less than 12 months, it is treated to be non-qualifying asset, in which case the entire borrowing cost can be taken to the P&L. In fact, if you are capitalizing borrowing cost, one needs to be remember that as per IND AS 23, you will take the borrowing cost less income on temporary investment of surplus funds during that period, and only the net borrowing cost for specific borrowings needs to be capitalized. Institute has asked you a couple of questions on those lines. So this by and large takes care of your initial cost basic concepts. Then you go to the slightly more advanced and special cases. Two special cases over here. First is deferred payment, second is barter. Usually the standard believes that your normal credit terms can extend maximum up to 12 months. If there is a credit period which is extending at or beyond 12 months, the institute believes that this is not normal credit. There is a hidden loan involved. And as a result, we will not account for a transaction where credit period goes at or beyond 12 months in the normal way. Like for example, if you go to Chroma, the AC is costing 20,000 rupees. Chroma says that if you pay immediately, you pay me 20,000, or you pay me after 2 years. You take the AC now, pay me after 2 years, in which case you pay 24,000. So in such a case, Chroma is giving you a 2-year credit. In normal business terms, no one gives you a 2-year credit as per IND AS, and hence it says that when it charges you 24,000, the additional 4,000 that it charges is essentially for time and not really for the asset. And as a result, the additional 4,000 rupees should be recorded as finance cost and should not be recorded as a part of the cost of the PP. So whenever the payment is deferred at or beyond 12 months, you will try to find the cash price equivalent, or if that is not available, the present value of the future payment. So 24,000, and you will find the present value. Let us say it comes to 20,000. Your PP will be recorded at 20,000. So PP account debit to payable 20,000. Then over the course of the next 2 years, P&L account debit to payable, P&L account debit to payable in the form of finance cost, 2,000 approximately will be recorded. Your payable goes up to 24,000 and it gets discharged. Your PP is still 20,000. However, if the payment is within 12 months, then we consider this to be normal credit, and hence if some discount is offered, we treat it as a cash discount which can be taken to P&L. The moment the payment terms are at or beyond 12 months, there is no cash discount discussion at all. The entire transaction is treated as having a hidden loan on which you have to pay interest if you take the loan. You don't pay interest if you don't take the loan. Next special case involves barter. Barter has two subparts: barter lacking commercial substance and having commercial substance. So genuine barters where different assets are exchanged. So you are giving up land and acquiring a private jet. These are different assets, and hence the company's position will be different pre and post the barter. These transactions are called as transactions having commercial substance, and in such cases you will record the barter. In the barter, the asset that is received at initial recognition. Remember, in barter, if you are getting a private jet and giving up land, your journal entries debit what comes in, credit what goes out. So private jet account debit to land, credit what goes out. Land will be credited. Land will be credited at the WDV. Why? Because let's say the WDV of the land is 10, the fair value may be 15. However, if you are going to pay 10 rupees, if you are going to credit the land by 15 rupees, there will be a negative balance in the land, and hence you will credit the land by the WDV only. So where does fair value kick in? Where fair value kicks in when you are recording the private jet. We will say that usually for the private jet we pay cash. Here we are not paying cash, instead we are paying through land. So at what value should you record the private jet? Remember, the recognition base is cost, and cost is what you are paying for the asset. Usually you pay in cash, here you pay through land, and hence the fair value of the land given up is the first preference. If that is not available, then you take the fair value of the jet received. If that is also not available, then WDV of the land given up. So that is the hierarchy to be followed in case of barter transactions having commercial substance. However, you might enter into a transaction where you are exchanging similar assets, and due to that exchange, the position of the company pre and post barter will remain essentially the same. In such cases, you will say that this is a barter lacking commercial substance. Similar assets are exchanged, and this is like a barter on books and not a real barter, in which case the standard says you will record the asset at the WDV of the asset given up. The logic over here is, in case of barter, let's say having commercial substance, in case there is a balancing figure, that is taken to the profit and loss account as gain or loss on barter. And hence, if you want to create profits, you might structure barter transactions on paper so that you can book profits. So the standard says that if you are exchanging similar assets whereby the position of the entity pre and post the barter largely remains the same, in such a case you will treat this transaction as, let us say, you will treat this transaction, let us say, as a transaction lacking substance, in which case you will not record any further gain or loss, and hence what you are paying as per book value is exactly assumed to be same as what you are receiving as per book value. Okay, so this is your barter case. Next, you go to the subsequent expenditure. Now, what do you mean by subsequent expenditure? Expenditure after the asset is in the ready to use condition. It may be in the form of regular repairs or maintenance or replacements, which can be minor or even major replacements. So when we look at subsequent expenditure, any expense which increases the life or efficiency beyond what was originally assessed will be capitalized. Other expenses will be taken to the P&L. Like you are paying to regularly for car washing, etc. This will be taken to the profit and loss account. However, if you are paying anything like installing a CNG system which increases the fuel efficiency of the car, that amount will be capitalized. So if it increases the life or efficiency, you can capitalize. Otherwise, take it to P&L. Now, the exception to this is generally if there is a major replacement or a major inspection or a major overhaul. Whether it is major or not is subjective. From an exam perspective, you can assume it that a major new part being added is major unless given otherwise. So in such a case, the standard says that if it's a major replacement, you will add the cost of the new part to the asset. Irrespective of whether it increases life or efficiency, you will add the cost of the new part to the asset. At the same time, one part is coming in, one part is going out. At the same time, you will subtract the WDV of the part which is going out. Now the problem is you might not know what the WDV of the part going out is. In such a case, the standard says that you will have to infer it from the breakup available in the supplier's invoice. If not available, then the fair value prevailing when you purchase the asset, and even if that is not available, then you will have to infer it based on the notional cost. Now, how do you determine notional cost? We don't know the cost of the old part. However, let's say in an AC, there is an indoor unit and compressor. A compressor is faulty after a few years. You buy a new compressor. You don't know originally when you bought the AC how much is attributable to the old compressor. However, you now know that the new compressor has costed you, for example, 50 rupees today. So you can use that as a proxy and find out that if today a new compressor costs 50 rupees, then 5 years back probably it must have costed how much. So you will do some time value adjustments. Hypothetically, let us say it comes down to 30 rupees. In which case we would say 30 rupees must be included in the overall value of the AC when I purchased it. And as a result, this 30 minus depreciation will come to the notional WDV of the old part. So basically, whenever there is a major replacement, you will add the cost of the new part, subtract the WDV of the old part, which can be from the supplier's invoice, fair value, or most importantly, taking notional cost based on the new part as a proxy. Okay. Apart from that, there can be subsequent repair on a damaged asset. If the damaged asset was such that it was impaired earlier, then subsequent repair costs can be capitalized. But if the asset on earlier damage was not impaired, then subsequent repair costs should be taken to the profit and loss account. Okay. Then you go to subsequent valuation. At each balance sheet date, how will you value? As a matter of accounting policy, you can either use the cost model, that is, you can take the historical cost less accumulated depreciation less accumulated impairment and find the carrying value or WDV, or you can follow revaluation model. Now, most companies in practice actually follow the cost model, but from an exam perspective, revaluation model is fairly important because there are a fair bit of adjustments here. So, under revaluation model, you are allowed to revalue the asset at sufficient intervals. Sufficient intervals defined as annual intervals for assets having a volatile value, or 3 to 5 years for assets having a largely stable value. So you will try to find, let us say, your fair value at sufficient intervals, and then show the asset at fair value. Now, this poses a bit of a challenge, because is it necessary that if I decide to revalue one of my assets or one group of my assets like land and building, do I have to revalue every other asset? The answer is no. Well, why? Well, because the standard says that an entity is allowed to follow a particular valuation model for a class of PP, and a class of PP is defined as an item having a similar nature or a similar end use. So when I look at, let us say, a class of PP having a similar nature and end use, like if I have 10 plots of residential building, all of them have a similar nature and end use. However, residential building plots have different nature and end use as compared to motor vehicles or furniture items. So I can very well follow revaluation model for residential plots, at the same time follow the cost model for, let us say, furniture. So revaluation model or cost model has to be selected for a class of PP. And if the question remains silent, in general we assume that the company follows the cost model unless fair value is specifically given and certain instructions given for you to follow the revaluation model, in which case an assumption is made. Otherwise, we generally assume that we record using the cost model. Okay. Other than that, the accounting treatment for revaluation is something which is important. So if there is an initial upward revaluation, let's say you go from 100 to 150 rupees, let's say for land, then that 50 rupees will go to the revaluation surplus, which is a part of other comprehensive income. But if it's an initial downward revaluation, that is you go from 100 to let us say 80, the initial downward of 20 will go to the P&L. Subsequently, subsequent to the initial upward, let's say you go from 100 to 150, take 50 to the revaluation, you go downwards in the next year. From 150, the value falls down to let's say 80. Then the downward revaluation of 70 will first be adjusted from the revaluation reserve, and excess, if any, will be taken against the profit and loss account. On the other hand, if it was an initial downward revaluation, where you initially took the losses to P&L and then there was an increase, then the reversal will first be adjusted against P&L, and excess, if any, will be adjusted against revaluation. Now, revaluation surplus is one of those items which is shown as a part of other comprehensive income. Other comprehensive income is a separate layer of disclosure that you give below the statement of profit and loss. Within other comprehensive income, there are two parts. There is a reclassifiable as well as a non-reclassifiable OCI. Within reclassifiable OCI, if certain events happen, the balance will be transferred from the reserve to the statement of P&L. Examples include something like FCTR, foreign currency translation reserve. On the other hand, a non-reclassifiable OCI would mean that on happening of certain events, like if there was a PP, you revalued the PP from 100 to 150, took that 50 rupees in revaluation. The very next day you were to sell the PP. At what? 150 rupees, in which case your entry will be bank account debit 150 to PP 150. But then if the PP is not there, can the revaluation on the PP continue to appear? Answer is no. And hence the balance in the revaluation will be transferred, let us say, to retained earnings, if it is non-reclassifiable OCI. So in non-reclassifiable OCI, you transfer the balance from the reserve directly to retained earnings without routing it through the statement of profit and loss. And revaluation reserve is an example of a non-reclassifiable OCI. So you will accumulate the revaluation into a separate reserve called as revaluation reserve, and then on happening of certain events like sale of the asset, transfer that revaluation reserve pertaining to that particular asset to the retained earnings. That is compulsory. However, an entity also has a choice. Remember, this is optional and not mandatory. It has a choice of transferring the balance in the revaluation to the retained earnings in the ratio of depreciation as well, though it is optional, and as a result you can take a assumption if question remains silent. Okay. Next is revaluation, which is possible in or which is happening in case there is accumulated depreciation balance. So over here the asset may be worth 100 gross block, 40 may be the accumulated depreciation, and hence in your balance sheet you might be showing 60 rupees, which is a net block. Typically for companies, they can directly show the asset at 60 only. However, if I maintain two separate accounts, like the gross block at 100 and accumulated depreciation at 40, and there is a revaluation, like an asset worth 60 is now worth 90. So it is going up by 50%. Now how will I recognize? Well, in case I want to continue to show the gross block and accumulated depreciation, I'll have to adjust it somewhere. So if my fair value is going up by 50%, I will proportionately adjust the original cost from 100 to 150, that is PP goes up by 50, and accumulated depreciation from 40 to let us say 60, your accumulated depreciation goes up by 20. So PP account debit 50 to accumulated depreciation 20, and hence the balancing 30 goes to the revaluation. Alternatively, you said that the root cause of the problem is actually having the provision for depreciation, and as a result you eliminate the accumulated depreciation or provision for depreciation. So accumulated depreciation account debit to PP, you knock it off against the PP, so your asset becomes 100 minus 40, that is equal to 60, and that 60 you can possibly take directly to 90 rupees. So these are the two possible methods which are there in case you are having accumulated depreciation ledger in your books. Next, you go to the last part of the standard, which pertains to depreciation. Now depreciation in general is due to passage of time, obsolescence, etc. You will start depreciating the moment the asset is ready for use, not when it is put to use, but it is ready for use. And this depreciation can be done by using either the SLM method, WDV method, units of production method, or any other suitable method. Usually the data points that you need for SLM is the salvage value as well as the useful life. Now these are accounting estimates and these are bound to change. So the management is required to check for these estimates at the end of each year and see whether they are reasonable or not. If the management believes that these estimates are in fact reasonable, then it can continue with the same, or if it believes that the estimates have changed, then it will treat it as a change in accounting estimate and give a prospective effect. Remember, in practice, you also look at Schedule 2, where you look at the indicative lives as well as the salvage values. Though from an exam perspective, that Schedule 2 lives or estimates are not considered by the institute, and hence we will ignore the same. Also, there is a possibility that you might change the method of depreciation. You earlier started with SLM, now you move on to, let us say, WDV or vice versa. Institute believes that the selection of the method of depreciation is a matter of accounting estimate based on the pattern of economic benefits you are estimating, and hence if the entity decides to change the method of depreciation, that may be due to it deciding to change its estimates of pattern of benefits, and hence it is a change in accounting estimate to be treated as prospective effect. However, when you look at accounting policy of cost model or evaluation model, this is an accounting policy choice, and if I decide to move from cost model to, let us say, evaluation or vice versa, it is a change in accounting policy for which the effects will be given retrospectively. However, change from SLM to WDV or vice versa is a change in accounting estimate where the effects will be given prospectively. It's an important point for you to remember. And then you have the component method of depreciation. Now this is something which is interesting and important. Under the component method of depreciation, you are responsible for depreciating based on components. But then a car might have 2000 components. Do I have to depreciate each component in the car separately? The answer is no. The law says component method will apply if the asset has major components, okay? And these components have life which is different from the life of the asset. Like you have a car, a major component is the engine, but the engine's life is 10 years. By the way, the car's life is also 10 years. It is the same as the life of the engine, and hence you don't need to separate out and depreciate them separately, because the life is not different. However, if you were to buy a furnished flat, remember, an unfurnished flat may cost you, let's say, 300 rupees. A furnished flat might cost you 330 rupees. All else remaining same. 30 rupees extra that you are paying is for the furniture. Now, this furniture is a major part of this expenditure, and it has a life which is different. So the flat might have a life of 50 years, the furniture has a life of only 10 years. In such a case, you will depreciate the flat component, that is 300 over 50 years, that is 6 rupees per annum, whereas furniture, that is 30, depreciated over 10 years, that is divided by 10, comes to 3 per annum, and your total depreciation will be 9. So technically you will show the furnished flat at 330 minus 9 of depreciation. Some entities might also opt to show the furniture element separately and the flat element separately. If you decide to do that, then the flat element is 300 minus the depreciation of 6 rupees. The furniture element is 30 minus depreciation of 3 rupees. Nevertheless, irrespective of whether you decide to present it separately or not, if your asset has major components which has a different life as compared to the main asset, then you have to follow component method. Certain cases like cars, you have tires. Tires might have a life which is different, but they are not major. I mean, if it's a 10 lakh car, a tire might be hardly 5,000 rupees, which may not be major part. And hence, in practice, you might not segregate and depreciate them separately. Now, this guidance that you have for component method applies to major components in your assets ledger balance. Your components may be physical parts, or your components may also be cost elements like inspection or overall. Like you look at an airline industry, for example, I might purchase an aircraft for 100 rupees and then incur 20 rupees as major inspection cost for getting a fit to fly certificate to get the aircraft in the ready to use condition. Now, when I look at my initial cost, it will be 100 plus 20, that is 120. Now, the aircraft has a life of 10 years, but my fit to fly certificate has a life of, let us say, only 4 years. In which case, I will say that out of my total 120 ledger balance for the aircraft, 100 will be depreciated over 10 years, whereas the 20 rupees will be depreciated only over 4 years. And thereby, a component method will be applicable, and you will depreciate the aircraft at 100 divided by 10, that is 10, and 20 divided by, let's say, 4, that is equal to 5, and 15 per annum. Now this will keep on going. First 4 years, then you incur again new inspection, add the cost of the new inspection, subtract the WDV if any of the old inspection, again depreciate the remainder of the aircraft for 6 years, add the and the inspection component by 4 years. and in the last 2 years you do further inspection. Now this inspection may have a validity of 4 years, but you don't intend to use the aircraft for 4 years, so you will depreciate the aircraft component by 2 years only, but inspection report has a validity of 4 years. In such a case, if your component has a life which is greater than the life of the parent asset, the law says you will depreciate it over the life of the component or remaining life of the asset, whichever is shorter. So for the inspection element as well, you will depreciate it over the remaining 2 years only. Okay, and the last part is, what if there is a change in the estimate of provision for site restoration? We have discussed that the impact for cost model would be adjusted against the PPE. However, what happens in case of a revaluation model? Remember, in case of a revaluation model, you will revalue the asset. And if you revalue the asset, any change in the value of the asset is to be taken in the revaluation reserve, and the asset will appear at fair value. Now, when you look at site restoration, let us say your asset was worth 100 rupees and there was another 10 rupees of site restoration cost, which means the asset appeared at 100 plus 10, that is 110 rupees, and 10 rupees was appearing as site restoration. Let us say now a year passes, let's say useful life of the asset is 10 years, your asset will be depreciated from 110 minus 11, so it is 99. Maybe there is some unwinding in the site restoration, maybe 10 rupees plus 1, that is 11. So your asset is appearing at 99 and your site restoration obligation is appearing at 11. Now if there is a buyer who comes to take your asset, the buyer automatically takes over your site restoration obligation as well. So if the buyer quotes that he will pay you 105, or the buyer quotes that he will pay you 95 for the asset, you might say that in my books the asset is worth 99 and the buyer is paying 95, which means there's a 4 rupee loss. Incorrect. When the buyer takes over the asset, he also takes over the site restoration obligation, and hence the buyer is paying you 95 for the asset and liability both. That is, for an asset worth 99 minus asset as a debit balance, liability as a credit balance, liability worth, let us say, 11, and hence 99 minus 11, that is for something worth 88, he is paying you 95, and hence the change of 5 rupees is treated to be the revaluation. Assuming that the asset is not sold and you are following the revaluation model, this 7 rupees, that is 95 minus 88, that is 7 rupees additionally you are going to get. That is due to revaluation. If it is upward, it will go to the revaluation surplus. Now going forward, remember, it is possible in the next year all else remains constant. Your assets value continues to remain, for example, at 99, hypothetically, okay? The very next instant we are saying that this is happening, the assets value is remaining at 99 rupees only. However, now you think that on dismantling, instead of paying 11, you think that the dismantling cost is falling and dismantling cost is only, let's say, 3 rupees, hypothetically. So provision account debit, so provision will be debited by I think 11 minus 3, that is equal to 8. The problem is, what will you credit? Now one has to remember that now a day later, let us say the government allows an explosion technique to dismantle buildings. So we say it will not cost us, let us say, 11 rupees in present value terms, it will hardly cost us 3 rupees in present value terms to dismantle. So we are going to save 8 rupees in present value terms. Now the very next day if you go to the buyer, will the buyer still quote you 95 rupees? Answer is no. The buyer would say that I was paying you 95 to take over the asset and the liability. Probably I was believing the liability is going to be 11 rupees, but now I believe the liability is going to be only 3 rupees, and hence I am ready to pay you even more. Maybe behind the scenes, the buyer thought that the value of the asset alone, had there been no site restoration obligation, was 106. I said 106, I am ready to pay for the asset, but 11 rupees is your liability that I am taking, so I will pay you 106 minus 11, so that is 95. However, now there is no longer a dismantling liability worth 11 rupees, it is worth only 3 rupees. The asset is still worth 106. So the buyer might be ready to pay you 106 minus 3, that is equal to 103. That is the fair value. What the buyer is willing to pay you might increase. Any change in the value under the revaluation model goes to the revaluation reserve. So this change is due to, this change in the overall value is due to your reduction in the estimate for site restoration. So you will say provision for site restoration account debit, that is whatever it is, 8 rupees, to what will be credited revaluation reserve. As per the appendix to IND AS 16, because any changes in the value of the asset should go to should go to revaluation reserve, we will take this amount also to revaluation. The asset will not be directly impacted over here. So long story short, if there's a change in the provision for site restoration, under the cost model, we are showing the asset at cost, and hence if there's any change in the cost, it should be taken against the asset. But when we are measuring the asset using the revaluation model, any change in the value of the asset ideally goes to the revaluation. That change may be due to asset becoming more superior or a site restoration liability actually reducing. In such a case, any changes in the value of site restoration will be adjusted against your revaluation surplus only. So this kind of takes care of your discussion pertaining to PP. We have tried to do it in the best length as well as coverage possible. The important questions, let us say from your Super 99 file, there are two questions which are very exhaustive, I would say pretty much. Question 1 is from study material, and question 2, I mean, to be honest, if you even revise question 2, that is sufficient. Question 2 is an exam question where institute has quite beautifully covered multiple concepts and covered a question. So let us quickly review question 1 because it is there in your study material, and then jump on to question 2. From an exam perspective, question 2 is much more exhaustive. So let us review this. This is from your Super 99 file. On 1st April 11, Sun purchased some land for 10 million, which includes legal cost, let us say, of 1 million. So will that be added? Well, the answer is yes. 10 million including the legal cost will be added. That is the cost of the land in order to construct the factory. Okay, construction work commenced on 1st May. Now you purchased the land on 1st April, but you did not start construction immediately. You started construction on 1st May. So any cost which is linked to construction will be incurred from 1st May. Sun incurred the following costs in relation to the construction. Preparation, leveling of land. So this is very clearly given that these are costs relating to construction, and hence we will say that these are costs attributable to the building element. So over here, preparation on leveling of land. Well, this is directly attributable to construction, will be added. Purchase of materials for construction, 6.08 million. Again, this is material cost, directly attributable, will be added. Employment cost for construction workers is 2 lakh per month. Now this will start from 1st of May because construction started from 1st of May and it will continue till the time construction continues. Now we don't know till when does construction continue, till whichever time it continues we will consider that. Overhead costs incurred directly, emphasis on the word directly, for construction of the factory, 1 lakh per month. Again, this is per month, so this will start from 1st May 11 when the construction starts, continues till the time the factory is actually completed. Ongoing overhead cost, ongoing. So this is not directly attributable, it is generic because it is ongoing. Allocated to construction using the company's normal allocation model is 50,000. Now this will be general in nature and hence it will be taken to the P&L. It is not directly attributable. Second, income received during temporary use of the factory premises as car parking during the construction period. This will also be taken to the profit and loss account. This will not be capitalized but be taken to the profit and loss account. Cost of relocating employees to work at the new factory. Remember, relocation cost is one of those items which is not treated as directly attributable, and hence this will also be taken to the profit and loss. And the cost of opening ceremony like inauguration expenses will also be taken to the profit and loss. So basically these last 4 items, maybe incomes or expenses, are to be taken to the P&L and will not affect the cost of the asset. Now the factory was completed on 30th November 11, which is considered as a substantial period of time as per Ind AS 23, which means this asset is a qualifying asset. But it was completed on 30th November 11 and the production began on 1st February 12. So maybe it is put to use from 1st February 12, but it is ready for use as on 30th September 11, and hence cost incurred up to, it is ready for use from 30th November 11, and hence the cost incurred, which is directly attributable up to 30th November 11, that is for a 7-month period, should ideally be capitalized. So this is from 1st of May to, let us say, 30th of November 11. So for us the relevant period would be a 7-month period up to 30th November 11, and hence 1 lakh into 7, that is equal to 7 lakhs, will be added on account of overheads, and 2 lakhs into 7, that is equal to 14 lakhs, will be added on account of labor cost. Again, till 30th November 11, any borrowing cost can be capitalized, Beyond that, it will be taken to P&L. Depreciation will start from 30th November. The date when it is ready for use is what is more relevant. The overall useful life of the factory building was estimated as 40 years from the date of completion. However, it is estimated that the roof will be replaced 20 years after the date of completion, and the cost of replacing the roof at current prices would be 30% of the total cost of the building, not land and building, just the total cost of the building. So what is the relevance of this? This will be relevant for the purpose of, let us say, component method. When you incur material, labor, etc., and you say that by 30th November your factory is ready for use, that must be having the existing roof. The factory survives for 40 years. However, your existing roof will survive for 20 years only and will require replacement. And as a result, the cost of the new roof uh, uh, will have to be incurred after 20 years. But that is a cost to be incurred after 20 years, not today. So then why is it given? Well, it is because you want to depreciate the roof component over 20 years and the other building component over 40 years. Remember, land, there is no depreciation at all. Okay. So over here, this is for the component method. You will somehow try to find the cost of the building. 30% of the total cost of the building is attributable to roof. That you will depreciate over 20 years to find the per annum depreciation. The remainder 70% you will depreciate over uh, 40 years to get the per annum depreciation. However, your depreciation will also be in the current year from 30th November 11 to 31st March 12. So probably this is a period of 4 months. So you will not get the entire year's depreciation because the asset gets ready for use in November only. At the end of the 40-year period, Sun has a legally enforceable obligation to demolish the factory and restore the site in its original condition. So there's a site restoration obligation. The directors estimate that the cost of demolition in 40 years time based on the prices prevailing at that time would be 20 million. An annual risk adjusted discount rate which is appropriate to this project is, let us say, 8%. The present value of 1 rupee payable in 40 years time at an annual discount rate of 8% is 0.046, and as a result you would say 20 into 0.046. 20 is to be incurred after 40 years, so into 0.046, that is approximately 0.92 million or 9,20,000. So we can say 9,20,000 is the present value of site restoration, and the event that gives rise to this obligation is the construction, not land purchase, but the construction that you have to dismantle. Okay, and this last part pertains to IND AS 23 borrowing cost. This is where there is some bit of controversy, otherwise the entire question is fairly clear. The construction of the factory was partly financed by a loan of 17.5 million taken on 1st April 11. Okay, so the loan is taken on 1st April 11 and the loan has an annual rate of 6%. Now the question has somewhere very categorically told you that this is a qualifying asset. And because it is a qualifying asset, borrowing cost that is incurred for the purpose of qualifying asset should be capitalized. So this is a loan which is taken for the purpose of construction and hence it is a specific borrowing. So basically 17.5 million is the loan amount into 6%. However, this loan might be in existence from 1st April, will probably continue for the entire year, but how much borrowing cost should you capitalize? Question says Sun received investment income of 1 lakh on temporary investment of the proceeds, and you are required to compute the carrying amount of the factory as on the balance sheet date on 31st March 2012, showing treatment of all amounts referred. Now when I look at this, I would say that ideally the loan is taken from 1st April 11, but is it taken for construction? Is it taken for purchase of land? No, it is very clearly said that it is for the purpose of construction. Did construction start on 1st April 11? No, the construction activities commenced on 1st May 11, and hence as per IND AS 23, the commencement will be later of the date when loan is taken, expenditure incurred or activities commence, which do commence on 1st May, and as a result, your commencement is from 1st May. Now this loan might continue for the entire year. However, the asset is ready for use on 30th November 11. And as a result, once the asset is ready for use or substantially all the activities to get the asset in the ready to use condition are completed, you will stop capitalization, and hence this is into 7 months. So this is into 7 by 12, and if I do the working, this is approximately 6,12,500. So this is your borrowing cost which is attributable to the qualifying asset, because you have been clearly told that this is a qualifying asset. Now the question also says that there is income on temporary investment of surplus funds. This is where there is a bit of controversy. The question does not tell you that that income pertains to what period. Institute has assumed that this 1 lakh entirely pertains to the period between 1st May to 30th November only. Now one can always argue that there was surplus funds also in the first month, that is on 1st of April to 30th of April. Well, Institute has not considered that. Can you consider it? Possibly yes, but I would say you avoid. You might as well solve it in the way the Institute has done. Also, one can always argue that 17.5 million is not needed entirely for construction. Remember, if it is a specific borrowing, you will not go into all of that. You will say whatever is the actual borrowing cost from the commencement date till the cessation date, less income on temporary investment, and that will give you the net borrowing cost to be capitalized. So the net borrowing cost to be capitalized as per ICI solution across, whether it is in the study material, whether it is in the RTP or in the exam question, is your cost during the construction period less income on temporary investment of surplus funds, and that will be 5,12,500, and that will be capitalized. So if I were to find the cost of the factory on 30th November, the date is ready for use, it will include 1 crore for the land. This is purely land, and then everything else is linked to construction, and hence this is for the building element, whether it is leveling, materials, employment cost, direct overheads, site restoration. Restoration is also linked to construction. Borrowing cost is also for construction, and hence when I total this, it is 1 crore 99,12,500, out of which 1 crore is attributable to land where there is no depreciation, and the remaining 99 lakh 12,500 is attributable to building. Now we have been told that within the building 30% is attributable to roof, 70% is attributable to the other parts, and hence 99 lakh 12,500 into 30%, whatever that comes to, probably that is around 29 lakh and something. This is attributable to roof, which will depreciate over 20 years to get the per annum depreciation, and then figure out how much is the 4 monthly depreciation. The other part, which is 70%, comes to around 69 lakhs, depreciated over 40 years into 4 by 12. So this is around 57,000. So if you want to find the carrying value in the balance sheet, land will appear at 1 crore. Of the building, that is 99 lakh 12,500. You will subtract I think 49,000 and 57,000, approximately 1 lakh 7,000 of depreciation to get the carrying value of the building. Are we clear with this? If you want, you can show the land part separately, or you can just show the value of the factory building. Okay, next is question number 2, which is May 23 paper. Now this is by and large similar to the earlier question. So if you get the earlier question well, this should be a sail through, except a few additional adjustments. So on 1st May, Sanskar purchased 42 lakhs worth of land for a new warehouse. So this will be added as land cost. The land purchased had an old temporary structure which was demolished for the purpose of construction. The salvage material from the demolition was to be sold as scrap. So the demolition cost minus income on sale of scrap is going to be considered as directly attributable. The company started construction work on 1st June. Again, you have this thing that the construction is starting on 1st June. The following costs were incurred by the company with regard to purchase of land and construction of warehouse. Legal fees for purchase contract of land and recording ownership. This 1,50,000 will be added along with land. Architects and consultants fees, which is usually attributable to building because this is linked to construction. Cost of demolishing the existing structure on the purchased land. Now this you will have to figure out to what does it pertain. You could have made an assumption, though the institute has somewhere mentioned. Second last point, assume that the cost of demolition of old structure is directly attributable to the cost of the land. Because it is directly attributable to the cost of the land, we will take it along with the land only. So over here, this will be added along with land as it is given. Okay. Site preparation charges for the warehouse. This is site preparation charges so that you make it ready for the warehouse. So this is also directly attributable but to the building. Purchase of cement and other materials for construction. This is for construction, so this is attributable to building, including GST of 1 lakh, and GST credit of 50% is available for the payment, and hence you will take this at 14 lakh 50 because this includes 50,000 of GST for which credit is available. Employment cost of construction workers is 8 lakhs, which will usually be added to the building element. General overheads, which is allocated, it is general, so it will be taken to P&L. Overhead costs incurred directly on construction of the warehouse, this will be added to the building. And income received on land used as temporary parking during the construction phase, well, this is to be taken to the P&L. Additional information, receipt of 35,000 being proceeds on sale of salvage and scrap materials from demolition of existing structure. So this will be deducted and hence minus 35,000. So net 1 lakh rupees will be taken. Materials costing 40,000 was wasteful and further 1 lakh 20 was spent to rectify the wrong design. So this is interpreted to be further 1 lakh 20 of materials. So as per one of the alternative solutions given by the institute, this is 1 lakh 45 minus 40 for sure and also minus 1 lakh 20. So some students had argued that 1 lakh 20 is nowhere mentioned that it is already included above, but it is not even mentioned that it is not included above, and hence institute has given two alternative solutions. So if you assume that this 1 lakh 20 was included in the above cost, then you subtract it. If you assume it is not included, then there's no question of subtracting because it is not included in the first place. Okay. The employment costs are for 10 months, that is from 1st June till 31st March. And the construction of the factory was completed by 20th February, which is considered as a substantial period of time as per IND AS 23. So over here, your relevant period is from 1st of June to around 28th of February, which is 7 plus 2, that is 9 months. Whereas employment costs are for 10 months. So this is 8 lakhs into 9 by 10. And hence this will probably come to around 7 lakh 20,000, which will be added into the cost. The use of the warehouse commenced on 1st March, so depreciation will be there for 1 month. The overall life of the factory was 25 years from the date of completion. However, it is estimated that the roof will need to be replaced in 15 years after the date of completion, and the cost of replicating the roof would be 25% of the cost of the building, an exact same adjustment as compared to what you did. So you will find the cost of the building, and from that 25% will be attributable to roof, which will be depreciated over 15 years. Other parts of the building 25 years, depreciation will be for 1 month. At the end of the 25-year period, Sanskar is legally bound to demolish and restore the site. Directors estimate that the cost at 25 years time would be 80 lakhs. Annual discount rate is 10% and the present value is 0.092. So 80 lakhs into 0.092 and you will get the value of site restoration. Sanskar raised a loan of 60 lakhs at 10% on 1st June. The building of the warehouse meets the definition of qualifying asset as per IND AS 23, and they received an investment income of 25,000 on temporary investment. So basically this is 60 lakhs into 10% into 9 by 12. So basically this is probably 4 lakh 50, out of which 25,000 will be subtracted, and hence this will come to 4 lakh 25,000 net. Okay. Cost of construction of the warehouse. So you are supposed to find the construction cost, the depreciation charge for the year. Land does not have any depreciation. Carrying value of the warehouse to be taken in the balance sheet as on 31st March. So if you want to show, you can show land separately, but otherwise they are asking you predominantly about the warehouse and explain the treatment of all the items. So as you see, land, legal fees and net cost of demolition. This is 44 lakh 50 is pertaining to land, no depreciation over here. Other everything 2 lakh 70. Cement and other materials, we have subtracted 50, 40 and 1 lakh 20. There's an alternative solution also possible for this 1 lakh 20 as we discussed. Then for the construction workers, direct overheads, this is 35,000 into 9. This is also for 9 months. 4 lakh 50 minus 25, and then demolition cost. This is 38 lakh 56,000. Out of this 38 lakh 56,000, roof will constitute 15%. Other parts, roof will constitute I think 25%, and other parts will constitute the remainder. And as a result, we will find that 25% depreciated over 15 years, as you can see over here, 15 years, and the other parts over 25 years, and accordingly come to your depreciation and the final carrying value for the warehouse. So largely I would say that this is also a question which is based on the study material question, and there was another question as well where you had some loss adjustments, etc. So if you revise this second question, by and large it's a much better question. There are a few other concepts as well for PP where you need to practice sums like changes in site restoration, etc. under evaluation model, but they have never come in the exam per se. So this is the base case for the exam. I hope this video has been helpful for you, and I'll see you soon with another video. Till then, goodbye, good luck, and take care.